So welcome back to the Layers channel. So basically today we will be breaking down Fama's paper, that is the behavioral behavior of stock market prices. And we are going to highlight the most surprising and counterintuitive insights that the traders absolutely need to know. So let's take an example. What if everything that the chart traders believe, for example the patterns, the trends, the signals, that is completely useless? So in 1965, a 26-year-old economist named Eugene Fama published a paper that shook even the Wall Street. Uh, yeah, and even after 60 years, most professional fund managers still couldn't accept what he did prove at that time. So we will look at 10 important insights from this. uh, Focus on only the green line that I have highlighted, and I will break down it into simple uh, simple language so that everyone could understand. So let's get to the first uh, insight. The insights are not each paragraph. I will inform when the second insight starts. So this one will be the first insight. uh, this line, basically, they all assume that the past behavior of a security price is rich in information concerning its future behavior. History repeats itself, and that patterns of past price behavior will tend to recur in the future. So what this means that every chart analyst, every technical trader who draws trend lines and look for patterns is making one key assumption that the history repeats itself. But Pharma says that assumption is fundamentally wrong. So let's get to the next paragraph under the same insight itself. By contrast, the theory of random walk says that the future path of price level of a security is no more predictable than path of a series of cumulative random numbers. So what this means that, by contrast, the random walk theory says that something is very shocking, that the future path of a stock price is no more predictable than a series of random coin flips. Continuing this next line, in statistical terms, the theory says that successive price changes are independent, identically distributed random variables. Simply, this implies that series of price changes has no memory. That is, the past cannot be used to predict the future in any meaningful way. So, in statistical terms, what this means, price carries no memory. What happened yesterday tells you nothing about what will happen today. So, this is the basic idea of a random walk theory. You can search random walk theory in YouTube. You will get to know various things if you want to deep dive into random walk theory. So let's get to the second insight. uh, Random walk model. This one, the random walk model is valid as long as knowledge of the past behavior of the series of price changes cannot be used to increase expected gains. More specifically, the independence assumption is an adequate description of reality as long as the actual degree of dependence in the series of price changes is not sufficient to allow the past history of the series to be used to predict the future in a way which makes expected profits greater than they would be under a naive by an whole model. So now this is where it gets really interesting and counterintuitive. So Pharma doesn't say there are zero patterns in stock prices. He says even if small patterns exist, they probably cannot make you money after the trading cost. So this is the main fundamental theme that Pharma spoke here. Mm, Continuing the second insight itself, uh, from a just a minute. Uh, 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 hmm. This one, for trading purposes, however, as long as epsilon is very small, this perfect negative statistical dependence is unimportant. Any profits the trader may hope to make from it would be washed away in transaction cost. So for example, let's imagine you found a pattern where a stock always goes up 1% and then down 1%. Statistically, that's dependence, but practically, any profits that you'd be making be eaten up by the transaction cost. Pharma calls this minimum acceptable dependence statistically real, but economically it's just useless. Coming back to the moving forward with the third insight. Let me see. This is the third insight. Page 38. Mm-hmm. Hmm. So in page 38, this whole paragraph is of high importance. So let's read out this. If there are many sophisticated traders in the market, however, they may cause these bubbles to burst before they have a chance to really get underway. For example, if there are many sophisticated traders who are extremely good at estimating intrinsic values, they will be able to recognize situations where the price of a common stock is beginning to run up above its intrinsic value. Since they expect the price to move eventually back towards its intrinsic value, they have an incentive to sell this security or to sell it short. If there are enough of these sophisticated traders, they may tend to prevent these bubbles from every occurring. Thus, their actions will naturalize the dependence and noise generation process and successive price changes and will be independent. So, here is one of the most elegant and surprising ideas in this entire paper. It's actually smart traders, the best analysts, and the forecasters who cause prices to become very unpredictable. By competing to profit from patterns, they eliminate those patterns. So, this is the main idea of this whole paragraph. Um, you can pause the video and understand this paragraph or use any LLM to understand this paragraph, but yeah, this is of very high importance. So under the same insight, this insight 3, coming back to the next point, the effectiveness of their activities in erasing dependencies in series of price changes can however be reinforced by another neutralizing mechanism. As long as there are important dependencies in the series of successive price changes, opportunities for trading profits are available to any astute chartist. So, in other words, the better and smarter the market participants, the more random looking the prices become. It's paradoxical basically. Intelligence just produces randomness. As simple as that. Moving forward with the insight 4, that is the chart reading becomes useless the moment it works. So let's get to that. Okay. Focus on this. We'll get back to this paragraph later. Focus on this now. Now, although the activities of the reader may help to produce independence of successive price changes, once independence is established, chart reading is no longer a profitable activity. In series of independent price changes, the past history of series cannot be used to increase expected profits. So this one will just blow your mind if you take a pause and understand this. Even if chart reading helps create efficient markets in the short run, once the market becomes efficient, chart reading immediately stops working. It destroys its own usefulness. So basically, the chart adapts itself to the very smart people or the analysts, let's say. Mm, then let's move to the insight 5, that the price adjusts but they overshoot and undershoot. Basically, this is the theme of the insight 5. Uh, Let me see. In fact, page 39. Hmm. Let's get back to this paragraph. In fact, however, there is a vagueness or uncertainty surrounding new information. Instantaneous adjustment really has two implications. First, let's say actual prices will initially over adjust to the new intrinsic values as often as they will under adjust. Second, the lag in the complete adjustment of actual prices to successive new intrinsic values will itself be an independent random variable, sometimes preceding the new information, which is the basis of the change. That is, when the information is anticipated by the market before it actually appears, and sometimes following. It is clear that in this case, the successive price changes in individual securities will be independent random variables. So a lot of traders believe the market always underreacts to news. So you can buy right after good news and profit as prices catch up. But Pharma has a nuanced response to this. So yes, the prices adjust to new information, but they are just as likely to overshoot as to undershoot. You can't symmetrically just exploit either direction. So basically, this is for news traders who just gamble around. So just look at this paragraph, have a look at this paragraph, understand it clearly, use an LLM, break down each sentence into a insightful into an insight, then try to understand this. So this is very important. uh, Under the same insight, let's get to the next. Okay, it's done. Hmm. Okay, it's done. Let's get to the next insight. That is, the stock prices are not normally distributed. So let's get to page 42. Candle, huh. This one. The candle observed that weekly prices changes in British common stocks seem to be approximately normally distributed. Like More, however, he finds the most of the distributions of price changes are leptochaotic, and that is, there are too many values near the mean and too many out in the extreme tails. So here is the that very important insight, that every finance student is taught wrong basically. Almost every financial model, starting from black calls to value at risk, assumes that the stock prices changes follow a normal bell curve, but Pharma's empirical data says that this is simply not true. uh, so what does leptochaotic means? uh, Basically this line: the presence in general of leptokurtosis as empirical distribution seems indisputable. In addition to the results of Kendall and Murray cited above, these all you can read this. Basically, there are too many changes greater than plus minus 10%. So, what does leptokurtic mean? It means crash days, those minus 10% and minus 20%. You can see that, yeah, even happened recently for Bitcoin, for gold, and everything. That shouldn't happen under normal distribution, happen far more often than standard models predict. The fat tails are just real. Let's get to the Mandelbrot's bombshell, that the variance may be infinite itself. That is the insight 7. Let's get to page 43. This one. So Mandelbrot's hypothesis states that for the distribution of price changes in speculative uh, series, alpha is in the interval between 1 and 2, so that the distribution have means, but their variance are infinite. So in 1963, a mathematician, Mandelbrot, mm, the fractal guy, yes, made a radical claim that Fama takes very seriously in this paper. He proposed that stock price changes might have infinite variance, not just large swings, but mathematically the infinite ones. Just pause this video and take some time to understand what I mean by the infinite variance. So, moving forward, page 44. Huh? If the variance of distribution of price changes behave as if they are infinite, many common statistical tools which are based on assumption of a finite variance either will not work or may give very misleading answers. So why does this matter? Basically, because if variance is truly infinite, then most of the statistical tools we use, for example, the standard deviation, the portfolio optimization, other risk models, are technically just meaningless. They assume these models have a basic assumption that the variance is finite. Mhm. So Mandelbrot also found that the sample movement does not settle down to any limiting value, but rather continues to vary in absolute erratic fashion, precisely as would be expected under hypothesis. So Mandelbrot found empirical evidence for this when he looked at cotton prices across 1300 observation. The sample variance never stabilized. It kept jumping around erratically, exactly as you did expect if the true variance is infinite. The thing which I said for the example which Mandelbrot took, that is the 1300 observation for cotton prices, just Google it and search for it. you will get to know what Mandelbrot wanted to say. Then going forward with the insight 8, that the best analysts eventually eliminate their own edge. Let's get back to page 39. Mm, okay, if there are enough. This page 40. If there are enough superior analysts, their existence will be sufficient to ensure that actual market prices are on the basis of all available information best estimates of intrinsic value. In this way, of course, the superior analysts make intrinsic value analysis a useless tool for both average analyst and the average investor. So this is a very deeply uncomfortable truth for anyone in asset management. So the best stock pickers, the ones who can genuinely predict where prices are going, actually cause prices changes to become random. Their very success destroys the market inefficiency they were just exploiting. Then Hmm. Finally, let us briefly formulate a rational investment policy for an average investor in a situation where stock prices follow random walks at a very important time and actual prices represent good estimates of intrinsic values. In such a situation, the primary concern of the average investor should be portfolio analysis. So, if chart reading is useless and stock picking is mostly luck for average investor, what should you do actually? So Pharma gives a clear answer. Focus on portfolio analysis, pick your risk level, build a diversified portfolio, and stop trying to beat the market. You just can't beat the market. It's as simple as that. So page 40. Hmm. So if he decides that his portfolio requires an additional security from a given risk class, he can choose that security randomly from within the class. On the average, any security so chosen will have about the same effect on expected return and riskiness of his portfolio. So in random walk market, you don't need to know which stock is the best. If you have decided on a risk class, just pick any stock from within it at a random. On average, it will perform just as well. So basically, Pharma says here focus on the portfolio analysis rather than trying to beat the market and earning money. So let's come to the last insight, that is on the very first page, that is the page 34. Okay. This one. We suggest, however, that since the empirical evidence produced by this and other studies and report of the random work model is now so voluminous, the counter arguments of the chart reader will be completely lacking in force if they are not equally well supported by empirical work. So perhaps the most powerful line in this entire paper is exactly this. The Pharma isn't saying we have some data suggesting charts don't work. He's saying basically the evidence is now so overwhelming that the chart readers bear the burden of proof. So basically, you can have a look at this. So let's recap the 10 most counterintuitive insights from Pharma's 1965 paper. First one is the past prices cannot predict future prices. Second is even the real patterns cannot be profited from after the cost. Third, the smart traders basically make prices more random, not less. The fourth, chart reading destroys its own usefulness once it works. 5. Prices overshoot and undershoot news, making both direction unpredictable. Sixth, stock returns are not normally distributed, fat tails are real. Seventh, variance may actually be infinite, making the most risk models unreliable. 8. The best analysts eventually eliminate their own edge. Ninth, average investors should focus on portfolios, not stock picking. And the last one, the evidence is now so strong that the burden of proof is on the chartist. So, Iguana Pharma would go on to just went to win the Nobel Prize in Economics in 2013 for this paper. And the core message of this 1965 paper, it's just more relevant today than ever. So you can have a look at this. I will attach the link, or you can just search the behavior of stock market prices by Iguana Pharma. So you will get to know a lot more things about stock market trading and finance. and portfolio analysis, what Pharma wanted to say. You can have a read of the you can have a read the whole research paper. So yeah, so that's it for the today. We will get back with a new research paper or some other analysis. Keep update. I will keep updating you. So like, subscribe, hit the bell button. Thank you.